Today we're going to talk about depreciation, and it's not what it sounds like. Depreciation is a powerful tool that real estate investors use to maximize their returns and minimize their tax liability. It's an income deduction that allows real estate investors to take into account the deterioration on their property, just on the property itself, normal wear and tear. The value that can be depreciated is typically the cost of the property itself, excluding land, because land is land, dirt doesn't deteriorate. So it's the building and everything on top of the land. The specific depreciation method for each type of property, whether it's a residential property or commercial, are different. So it's important to consult with a tax professional if you have any questions on what I'm about to say. By the way, this is not legal advice. So unlike other deductions that you file with your rental property, like maintenance or your mortgage interest or mortgage insurance, depreciation allows you to make a deduction with no out-of-pocket costs, as opposed to if you were writing a deduction for the AC that you replaced last summer. So here's an example of what I'm talking about. Let's say you bought a single family home, you turned it into a rental property for $300,000, and the land value of that property is $25,000. With the purchase price being $300,000 and the land being $25,000, you're able to depreciate $275,000. This is what's called the depreciable basis. For residential properties or between 1 to 4 units, the depreciation period is 27 and a half years. This is where it gets fun. Let's say that property generates $10,000 per year in income. You're able to depreciate $10,000 per year off of your taxable income. So with the depreciation expense at $10,000 and your annual income at $10,000, in this example, you essentially get to keep every single penny that you received from your rental property. No tax paid on any of that $10,000 that you received in income. Yeah. You heard that right. But again, depending on the property, this can vary, so be sure to contact a tax professional before getting started. But continuing on here, if you think about this and you were receiving $10,000 and you got 10 properties generating $100,000 per year, and you're depreciating all of those properties, you can essentially live on all of these rental properties for $0 paid to Uncle Sam. There are potential tax consequences. Let me talk about the cons real quick. When you sell the property, the accumulated depreciation at that point needs to be recaptured, meaning it is added back as taxable income. However, keep in mind the time value of money. I talk to all of my clients about this. If you're planning on holding this property for 10, 20, 30 years, the savings today can be much more valuable than what you would pay once you decide to sell that property down the road. But of course, it's always something to consider and keep in mind. So yeah, in contrast, if you did not take advantage of depreciation today, you would be missing out on a ton of income deductions, which leads to higher tax liability and also reduces your cash flow. So over the long term, these savings and these deductions today could be game changers. And if this is all starting to sound foggy, shoot me a message, shoot me a DM, or again, reach out to a tax professional or a CPA for the full scoop on all these details. So depreciation is a powerful tool for any real estate investor. By depreciating your property and getting these income deductions, you're reducing your tax liability, which increases your cash flow and ultimately enhance your rental property. So thank you guys again for watching. If you stuck around this far, I appreciate you so much. Please like, subscribe, share this with your dog, and we'll see you guys next time.